London, once the beating heart of a global empire, now home to a crisis that's tearing apart the fabric of one of the world's most iconic cities. More than 1 in 4 Londoners are living in poverty today. Homelessness is 8 times the national average, and while families are being pushed onto the streets, nearly half of all property purchases in central London are being snapped up by foreign buyers who'll never even live there. This isn't just a housing problem anymore. It's a complete system failure that's locked an entire generation out of home ownership. And the numbers behind it are absolutely staggering. Right now, the median household in Britain brings home just under £37,000 a year. Sounds reasonable until you look at what they're up against. The median house price sits at £270,000. That's more than 7 times their annual income. But here's where it gets worse. To even qualify for a mortgage, you can't be spending more than 30% of your income on housing. That's the stress threshold that banks use. Do the math on a typical mortgage with a 10% deposit at 7% interest, and you're looking at payments of over £20,000 a year. That's more than half of what the median household earns, which means banks simply won't lend to them. You need a bank to buy a house, but the bank won't let you buy a house. It's a trap with no exit. Before we go further, make sure you hit that like button and subscribe to Property Reporter. We're bringing you the latest UK property and housing news that actually matters, cutting through the noise to show you what's really happening in the market. Don't miss out on the stories that affect your future. So how did Britain end up in this mess? The answer takes us back 4 decades to a decision that changed everything. Before 1980, house prices in the UK barely moved at all. And I mean barely. With inflation factored in, the house price index was at 47 in 1845. Over a century later, in 1960, it was still at 47. Prices were essentially flat for more than 100 years. At that rate, it would take 280 years for house prices to double. Then Margaret Thatcher became Prime Minister, and everything changed. Thatcher's government deregulated the finance sector in a massive way. Before her reforms, most home loans came from building societies. These institutions worked differently than banks. When a building society made a loan, money moved from their deposit accounts to the borrower's account. Simple transfer, no new money created. But banks operate on a completely different principle. When a bank makes a mortgage loan, it creates new money out of thin air. The bank's assets go up by the loan amount, and so do their liabilities in the form of new deposits. This expands the money supply, pumps more cash into the housing market, and drives prices through the roof. After Thatcher deregulated mortgage lending, banks took over from building societies as the main lenders, and that's when household debt absolutely exploded. Between 1980 and 2007, household debt increased by a factor of 4. It went from 20% of GDP to 80% of GDP. House prices followed the same trajectory, rising by 3% per year in real terms. At that new rate, prices were doubling every 23 years instead of every 280 years. The City of London made billions from this deregulation, but for average Britons, it was a disaster that keeps getting worse. The mechanism behind this is actually quite simple, but it creates a vicious cycle that's almost impossible to break. More mortgage debt pushes house prices up. Higher prices mean properties can be used as collateral for even bigger loans. Rising prices attract speculators who see houses as investments rather than homes. This drives even more demand, which pushes prices higher still, which encourages more debt. Round and round it goes. The cycle kept spinning faster and faster until it crashed the entire economy in 2008 during the global financial crisis. But even that crash didn't fix the underlying problem. Prices recovered, debt kept climbing, and now we're right back in crisis mode. Today's London tells the story better than any statistic ever could. Walk through central London and you'll see gleaming luxury flats with their lights off night after night. Ghost homes owned by overseas investors who bought them purely as assets. Meanwhile, 45% of all property purchases in the heart of the capital are made by foreign buyers. These aren't people looking for a place to live. They're parking money in London real estate because it's seen as a safe investment. And who can blame them when prices just keep going up? But this foreign investment tsunami has devastating consequences for locals. Every property bought by an international investor is one less home available for a British family. Prices get pushed even higher, further out of reach for ordinary workers. The human cost is written all over the city. Homelessness has skyrocketed to 8 times the national average. Families who've lived in London for generations are being forced out to cheaper areas, sometimes hours away from their jobs. Young professionals are resigning themselves to renting forever, watching their monthly payments disappear with nothing to show for it. The dream of home ownership has become exactly that for most people, just a dream, and the poverty rate keeps climbing. More than 1 in 4 Londoners now live below the poverty line. In one of the wealthiest cities on earth, a quarter of the population can't make ends meet. That's not a functional housing market, that's a broken system. But what if there was a way to fix this? What if we could reverse the damage done by decades of deregulated lending and foreign speculation? There are solutions out there, though they require political courage that's been in short supply. The first solution is called Property Income Limited Leverage, or PIL for short. Here's how it would work. Instead of letting banks lend whatever they want based on inflated house prices, mortgages would be limited to a multiple of the actual rental income a property could generate. Right now in London, house prices are roughly 25 times annual rental income. That's absurd. Under PIL, new mortgages would start at current ratios, but then gradually decrease over time until they reached about 10-1. This would have a dramatic effect on the market. Houses would stop being attractive speculative investments because the leverage would be capped. You couldn't borrow massive amounts to gamble on ever-rising prices. Properties would return to being what they should be, homes for people to live in, not chips in a financial casino. Obviously, this would put downward pressure on house prices, which is exactly the point. For the millions of people currently locked out of home ownership, falling prices would be fantastic news. But for property-owning baby boomers sitting on paper fortunes, this would be political poison. And that's why PIL needs to be paired with a second solution. The second solution is the Affordable Housing Authority, or AHA. This is where things get really interesting. The AHA would provide upward pressure on house prices while simultaneously making it easier for low-income households to actually buy homes. Sounds contradictory, right? But here's the key. It would cut banks out of the equation entirely. Remember how banks are non-existent middlemen for median earners? They won't lend to people who can't afford sky-high interest payments. But what if there was a lender that didn't need to charge interest at all? Here's the math that changes everything. Take that median household earning £37,000 trying to buy a £270,000 house. With a 10% deposit and a 7% interest rate on a 25-year mortgage, they'd pay over £20,000 a year. That's more than half their income, so banks reject them. But remove the interest entirely, and the annual payment drops to just £9,300. That's 26% of their income, which falls below the stress threshold. Suddenly, home ownership becomes possible. So where would these zero-interest loans come from? The Affordable Housing Authority would be financed through government money creation. Not taxpayer money, not borrowed money, created money. The same way banks create money when they make loans. The difference is the AHA wouldn't need to charge interest because it's not trying to make a profit. It would lend to buyers earning median wage or below. Those buyers would use the funds to purchase homes. The money would go to the sellers. And then the buyers would repay just the principal over 25 years. No interest. No massive wealth transfer to banks who contribute nothing to the actual housing stock. Now, some people might call this socialist nonsense. But let me quote 2 famous capitalists who understood this principle a century ago. Henry Ford and Thomas Edison were campaigning for a massive hydroelectric project to be financed through government money creation rather than bank loans. Edison said the problem with bank financing was that for $30 million of their own money, the American people would be forced to pay $66 million when interest was included. He called it the terrible thing about interest. people who don't contribute any materials or do any work end up collecting more money than the people who actually build the project. The same logic applies to housing today. Banks don't build houses, they don't contribute materials, they just create money and charge interest on it. Meanwhile, they refuse to lend to the very people who need housing most. The beauty of combining PIL and AHA is that they balance each other out. PIL would reduce leverage and put downward pressure on prices by limiting speculation. AHA would increase demand from low-income buyers who are currently shut out, putting upward pressure on prices. Sellers who'd lose out from reduced bank lending would benefit from increased demand from AHA-financed buyers. Even banks, who don't currently earn anything from below-average earners they won't lend to anyway, would earn interest on AHA bonds issued to keep the system balanced. Everyone wins. But here's the problem. Britain's major political parties won't touch these ideas. Labour and the Conservatives have both been captured by the financial sector. They still believe in outdated economic theories that favour banks over people. They talk endlessly about government debt while ignoring the private debt that's actually crushing households. But smaller parties might see an opportunity here. The Greens, Jeremy Corbyn and Zara Sultana's new party, George Galloway's Workers' Party. With more than half of Britain's voting age population now unable to buy a house, a platform built around PIL and AHA could be a massive electoral winner. It would give hope to millions who've been abandoned by the current system. The deeper issue that nobody wants to talk about is private debt itself. Politicians obsess over government debt figures, while private debt has ballooned to catastrophic levels. Household debt quadrupled as a share of GDP between 1980 and 2007. It crashed the economy once already, and it's climbing again. This private debt sits behind almost every social and economic problem Britain faces today. Young people can't start families because they can't afford homes. Workers can't save for retirement because rent swallows their income. Communities are being destroyed as long-term residents are priced out. And all of it traces back to the deregulation of mortgage lending and the explosion of private debt it created. The only real solution to excessive private debt is something called a modern debt jubilee. It's a way to reduce household debt without causing economic collapse. Ancient societies understood this principle. When debt became too burdensome, they'd declare a jubilee and wipe the slate clean. Modern economies need something similar but designed for today's complex financial system. The idea is to create new money and use it to pay down private debts directly. This would reduce the debt burden on households while maintaining the money supply in the economy. It wouldn't cause the deflationary spiral that normally happens when everyone tries to pay off debt at once. A modern debt jubilee would face massive political resistance, of course. Banks would lose out on interest income. Wealthy people who don't need debt relief would complain about unfairness. But the alternative is worse. Without debt relief, the current system just keeps grinding forward, crushing more families under the weight of unaffordable housing and unpayable mortgages. At some point, the debt burden becomes so heavy that the economy collapses under its own weight. We saw it in 2008. We'll see it again if nothing changes. The question is whether politicians will find the courage to act before the next crisis hits. London's housing disaster didn't happen by accident. It's the direct result of policy choices made over the past 4 decades. Deregulating bank lending, allowing unlimited leverage on property purchases, permitting massive foreign investment without considering the impact on local residents. Each decision made sense to someone at the time, usually someone in the financial sector, but the cumulative effect has been devastating for ordinary people. A city that once offered opportunity to working-class families has become a playground for the global wealthy, with actual Londoners pushed to the margins. The solutions exist. PIL would limit speculation by capping leverage based on rental income. AHA would enable low-income buyers to purchase homes through zero-interest government loans. A modern debt jubilee would reduce the crushing burden of private debt. Together, these policies could reverse decades of damage and restore home ownership as a realistic goal for average earners. But implementation requires political will that's currently absent from Britain's major parties. Until voters demand change loudly enough, the crisis will only deepen. What's happening in London is a warning for other cities around the world. When finance is deregulated and property becomes a speculative asset rather than a basic need, ordinary people lose. They lose their homes, their communities, and their future prospects. The wealth gap widens. Poverty spreads even in the richest neighbourhoods. And eventually, the social fabric tears apart. Britain is living through this transformation right now. The question is whether it will find a way to reverse course before the damage becomes permanent. If you found this deep dive valuable, make sure you're subscribed to Property Reporter and hit the notification bell. We're committed to bringing you the real stories behind UK property and housing news, not just the headlines, but the analysis that helps you understand what's actually happening and why it matters. The housing crisis affects millions of families across Britain, and we're here to keep you informed every step of the way. Drop a comment below with your thoughts on these proposed solutions. Could PIL and AHR actually work? What would it take to make politicians listen? Let's keep this conversation going, because the more people understand these issues, the harder it becomes for those in power to ignore them. The fight for affordable housing is far from over, and your voice matters in shaping what comes next.